Okay, welcome to 21-1 Work Together. Go ahead and click on your Work Together. It's a little bit of a longer one, so it's probably going to end up in two videos. Just to make sure that you're aware, it's got 5 steps doing some accruals here. So if we scroll down, we're going to see that we have a couple of things. We have a partially unadjusted trial balance with lots of information here. And then we also have some important information about each of our two. We have a note receivable and a note payable. And then we also have our chart of accounts in case you need to have that to find any of the accounts needed for journalizing. So it says that as we scroll down, we're going to journalize the adjusting entries for accrued interest income and accrued interest expense as of December 31st using page 14 of the general journal. So remember, we've done adjusting entries before. This is kind of a review of chapter 19, which was our long-term debt financing chapter. So I'm just going to try to make this as easy to see as possible. There we go. Okay, so what we really need is the information that comes from the question information tab. It says on December 31st of 20-1, Kufis Corporation has the following. So we have a note receivable and a note payable. So we're going to calculate our note receivable first. So we're going to plug in December 31st. And then we need to plug in what's going to be our adjusting entry. So remember, for adjusting entries, we have interest receivable is going to be our debit, and interest income is going to be our credit. Okay. So how do we find out how much interest receivable or interest income we need for an adjusting entry at the end of the year? Well, we come up here, it says that we have a $10,000 note, that's our face value. We have our interest rate of 6%, and then we have to do a little figuring to find the number of days that we've accrued interest for. So remember, November 16th, November has 30 days, so we take 30 minus 16, and that's 14. And then we take all 31 days that would be in December. So 14 and 31 is 45. So what that looks like is we take 10,000 and we multiply that by 6%. And then we multiply that by 45 divided by 360. And you should end up with $75. So $75 is going to be our interest receivable debit, and $75 is going to be our interest income credit. Okay, and that's our first one. Then let's come down here and do our second. We put our date in again as the 31st. In this one, because it's a note payable, it means that our adjusting entry is going to be for interest expense, and then our credit is going to be for interest payable. So this is one where we owe someone money. So it looks like we sign this one into effect on December 1st. So again, we take our 12,000, which is our face value, times the 6%. And since we signed it into effect on December 1st, we take 31, which is the number of days in December, and subtract out 1, and we get 30 days that we need to accrue for. So when we take 12,000 times our 6%, and then times 30 divided by 360, we end up with $60 as our amount for our debit and our amount for our credit. Okay. So that is step 1, doing an adjusting entry. And again, we've done this before, so this shouldn't be too new. Let's head over to step 2 and get ready to complete that one, which is journalizing our closing entries. Okay, so in step 2, we're actually going to close our interest expense and our interest income accounts. As if we were at the end of the fiscal period, which we are, we'll be closing both of those using page 14 of our general journal. So what we're going to do is we're going to come down here and notice that again, closing entries is written in here. That serves as our document number since we don't have that. So notice that what Applia has done is they've actually gone in and posted these amounts for us, and we have an unadjusted trial balance up here. So what we need to do when we're talking about closing entries, remember, and this is going a little bit farther back, is that both of these actually get closed into our income summary accounts. So what happens here is we have our first closing entry is for our interest income. So remember that income is an income statement credit account. So in order to close it, we need to do the opposite of its normal balance. Its normal balance is a credit, so we have to debit interest income. So interest income is going to be debited, and that means that income summary is going to be credited. Now, in order to find the amount of this, oh, we have an announcement here. We're going to keep going, okay? So if we come down here, we have our interest income is currently at $3,090. But remember that we had a credit to that of $75. So you need to add 75 to the 3,090. And when you do that, that updated balance should be 3,165. When we close, that's the amount that's going to go here. 3,165 and 3,165. Now, if we had T accounts, this would be so much easier to see, but we don't. So you have to imagine that the T account is there. We're crediting or debiting the opposite side, so now we're at a zero balance, closing those entries out. Let's do the same thing for our interest expense. Now remember that interest expense has a normal debit balance, so that would mean that in order to close it, we'd have to credit it. So interest expense is actually going to go here, and interest income is what gets income summary, is what's going to be debited because it's the opposite of what we just did up here. So again, same thing, our interest expense has a balance right now of $13.15, but remember that we debited $60 into it from our adjusting entry, so we take $13.15 and add 60, and you should get $13.75. So we come down here and we put $13.75. $13.75. That's going to close out those accounts, and we're going to end up back at a zero balance for both interest income and interest expense. Okay, so let's put this guy back in here, and let's head over to step 3, where we come into the beginning of our next fiscal period, and we're going to need to do some reversing entries in order to prepare everything for the next fiscal period. So remember that with a reversing entries are essentially the opposite of our adjusting entries. So it says that on January 1st of the following fiscal period or the next year, we're going to do reversing entries for our accrued interest and our accrued interest expense. So I'm going to throw this up here again and bring this down here. And so notice again that reversing entries is our heading. That serves as our document number. And remember that we're now on to January 1 of the next year. And so a reversing entry for our interest income is actually, we're just going to flip-flop that. So what happens is interest income is going to be debited and interest receivable is going to be credited. Okay? For the exact same amounts that we did before, 75 and 75. Now, when we do this, a couple of things happen. Our interest income is going to end up with that $75 as a balance, and interest receivable is actually going to be zero, because remember, at the end of the fiscal period, interest receivable was an asset on the balance sheet saying that we were going to receive $75. We're actually zeroing that out now with this credit. And what happens is we won't actually record that anywhere when we receive the interest. Instead, it's going to go directly into interest income. Okay? And then we're going to do the same thing for our expense account. So we come over here, we do January, oops, I guess we don't need January again, just the one. And in this situation, interest payable is going to be debited for 60. And then interest expense ends up being credited, okay, for $60. So again, what's happening here is that this interest payable was sitting as a liability on our balance sheet. That's now been zeroed out, and when we actually pay our interest, it'll all end up being squared away in our interest expense account, which is exactly what we're going to do when we get in here for steps 4 and 5. But this is your reversing entry. Remember, reversing entries are essentially the exact opposite of what our adjusting entries were. Okay, so let's head over to step 4, journalizing our notes maturities. Once we get there, our note receivable and then also our note payable. Okay, so as we come down here, it says that we're going to journalize the payment of cash for the maturity value of our note payable on March 1st of 2012 or the next year. Check number 478, we're using page 25 of the cash payments journal. And we're going to need our question information up here in our question assets to remember our face value as well as our interest rate and the number of days that we've had. So when we do this, I better come back up here to our cash payments. Cash payment, remember, is we're talking about our note payable. So what we're going to do here is we take our date, which is, I got to double check that again, on March 1st. So March 1. Our account title, remember, is going to be notes payable. This should be very similar to what we did during that chapter 19 of our debt financing unit. It's check number 478. Okay. Our note payable is getting debited for our face value. Remember, our face value is $12,000. Okay. And then our credit is going to interest expense. We need to calculate our interest expense for the entire value of the note. So we take our $12,000 times 6% times 90 divided by 360. And when we do that, we get a value of $180. And so when we pay that note off, it's the total of the $12,000 and the 180. So it's $12,180 is our total cash credit. Okay. Then we're going to come down here and we're going to journalize the receipt of cash for our notes receivable on March 16th using receipt number 278. So again, this time we're in the cash receipts because we're the one receiving the cash. So this is actually happening on March 16th. So we put in March 16th. And instead of notes payable, we have notes receivable. That's going in here. Our document number is R278. We do need the R this time just because cash receipts can come from more than just a receipt, so we do need the R. And notes receivable, remember, is an asset with a normal debit balance. So that means that this time, notes receivable is going to be credited. We're getting rid of that. And then we come down here, we also need to have our interest income. In order to figure our interest income, we need to go back up to our question information and we take that 10,000 principal value times 6% times 120 divided by 360. When you do that, you should have a credit of $200. And then our total cash coming in at the maturity date time is our total interest receivable plus, or excuse me, notes receivable plus our interest income, which is $10,200. Okay, so that's journalizing at the time where we are actually receiving cash and paying cash. So now what they're going to have us do is actually go on to step 5 and take a look at our T accounts and see how our accruals with our reversing entries are affected. Now that's going to be on the next video just because I'm running out of time here on our free video recorder. So you can head over to the next video to finish up step 5.